In 2021, the Indian stock market was buzzing with excitement. Startups were going public one after another. Zomato, Nika, Policy Bazaar, all raising billions. Then came Paytm, India's fintech poster child with the biggest IPO in Indian history, worth 18,300 crore rupees. But instead of being a celebration, the listing turned into a nightmare. On the very first day, the stock crashed nearly 27%, wiping out billions of investor wealth. So what went wrong with the Paytm IPO disaster? Why did the company that led India's digital payments revolution lose investor confidence so quickly? Stay tuned, because in this case study, we'll uncover Paytm's rise and journey, the cracks in its business model, the mistakes in its IPO strategy, the impact of its disastrous listing, and most importantly, the lessons every entrepreneur and investor must learn. Paytm was founded in 2010 by Vijay Shekhar Sharma as a simple mobile recharge platform. Back then, recharging your prepaid phone meant standing in long queues. Paytm solved that pain point, but the real turning point came in 2016 with demonetization.
मध्यरात्रि यानी 8 नवंबर 2016 की रात्रि को 12 बजे से वर्तमान में जारी 500 रुपए और 1000 रुपए की करेंसी नोट ये मुद्राएं कानूनन अमान्य हो गई।
When India suddenly banned 500 rupee and 1000 rupee notes, millions rushed to digital wallets. Paytm became the poster child of cashless India, with even Prime Minister Modi praising the app. From there, Paytm aggressively expanded into multiple verticals. Paytm Wallet, and later UPI Payments, Paytm Payments' Bank for digital banking, Paytm Mall to compete with Flipkart and Amazon, insurance, wealth management, ticket booking, gold purchases, and even gaming. By 2021, Paytm claimed over 330 million registered users and 21 million merchants, making it one of India's largest consumer internet brands. It wasn't just a startup, it was a symbol of India's startup revolution, backed by global giants like SoftBank, Alibaba, and Ant Financial. But as we'll see, growth on paper doesn't always mean success in reality. Despite its massive scale, Paytm had deep-rooted problems. Problem 1. No clear path to profitability. Paytm was spending heavily on cashbacks, discounts, and marketing to attract users. While this built scale, it also meant the company was bleeding money. By fiscal year 2021, Paytm reported a loss of 1,701 crore rupees on revenue of just 3,186 crore rupees. Losses were almost half the revenue. Problem 2. Fierce competition. The payments industry was becoming a red ocean. UPI, launched by NPCI in 2016, changed the game. Suddenly, Google Pay and PhonePe were leading UPI transactions, while Paytm's wallet became less relevant. In 2021, PhonePe and Google Pay together controlled approximately 80% of UPI transactions, while Paytm was a distant third. Problem 3. Too much diversification. Paytm was trying to do everything: e-commerce, banking, insurance, lending, wealth management. Instead of dominating one vertical, it spread itself too thin. Investors struggled to see what Paytm's core business actually was. Problem 4. Questionable valuation. Paytm's IPO sought a valuation of over $20 billion, 1.5 lakh crore rupees, making it larger than many profitable banks and established companies. Analysts questioned, how can a loss-making company be valued more than profitable giants? These problems made investors nervous, but Paytm pushed forward with its IPO. Paytm filed for its IPO in November 2021, aiming to raise 18,300 crore rupees, India's largest ever. Its pitch was simple. Paytm is the gateway to India's digital economy, a super app serving payments, finance, shopping, and more. Backed by the biggest global investors, over 330 million users already on board. The IPO was marketed with the slogan, India's Paytm, India Ka IPO. But here's the catch. While retail investors were excited, institutional investors were skeptical. Reports showed that mutual funds and foreign investors found the issue overpriced. The IPO was subscribed just 1.89 times, a weak response compared to other hot startups like Nykaa or Zomato. Then came listing day. IPO price 2,150 rupees per share. Listing at NSE 1,950 rupees per share, already 9% lower. End of day 1,564 rupees per share, down 27%. It was the worst debut for any IPO over 1,000 crore rupees in Indian history. Within 2 days, Paytm's market cap had eroded by 40,000 crore rupees. The crash shocked India's startup ecosystem. For investors, it was a painful reminder that hype doesn't equal returns. Retail investors who believed in the brand lost huge amounts. For Paytm, the fallout was even bigger. Its valuation collapsed by over 60% in the following months. By March 2022, Paytm was trading below 600 rupees per share, a far cry from its 2,150 rupee issue price. Analysts like Macquarie labeled Paytm a cash guzzler with no visibility of profits. Media called it India's biggest IPO disaster. Even Paytm's founder, Vijay Shekhar Sharma, broke down in tears in interviews, saying he felt like he had let down retail investors. Meanwhile, rivals like PhonePe and Google Pay continued to dominate payments. Paytm remained big, but its dream of being India's fintech kingpin was badly shaken. So, what lessons can we learn from the Paytm IPO disaster? Valuation must match reality. Paytm was valued higher than banks that were profitable for decades. Hype cannot replace fundamentals. Profitability is king. User growth means nothing if it doesn't translate into profits. Don't do everything. Paytm's super app dream made it look unfocused. Investors prefer a company with a clear, dominant business. Timing and pricing matter. IPOs must be priced attractively. Overpricing creates mistrust. Brand not equal stock success. Just because people use your app doesn't mean your company is a good investment. For entrepreneurs, the Paytm story shows that vision and execution must align. For investors, it's a reminder to research fundamentals before buying into hype. And that's the story of the Paytm IPO disaster. A story of ambition, hype, and reality colliding. What do you think? Was Paytm's IPO simply bad timing, or was it doomed from the start? Comment your thoughts below. I'd love to know. If you found this breakdown useful, hit that like button, share this video with a friend, and don't forget to subscribe for more deep dive business case studies. Thanks for watching, and I'll see you in the next one.